Welcome to the latest installment of ABL Advisors video series featuring thought leaders from the commercial finance industry. I'm Mike Toglia, the publisher of ABL Advisor, and today my guest is Lee Haskin, the Chief Executive Officer of Crossroads Financial. Thanks very much for being here today, Lee.
Mike, thank you very much for having me. It's a pleasure to communicate and share some of what we know and what we've learned over the many years with others. Thank you.
Sounds good, Lee. So before I jump into the questions, I thought maybe I ask you, if you can briefly, just tell us a little bit about Crossroads Financial.
Absolutely. Crossroads Financial, I grew up in the factoring industry. So about 16 plus years ago, I was trying to figure out what my next business move would be. And I recognized there was a tremendous void in the inventory lending space. So over 16 years ago, the primary focus was to do inventory revolvers in conjunction with a factoring or receivable lending facility, so that we would help people put on business they normally would not be able to put on when taking out a bank that lent on inventory or another lender that had done the same. So over 16 years ago, we worked out intercredit agreements, which is a foundation of what Crossroads has begun. Probably nowadays, the majority of our portfolio is e-commerce and brick and mortar retail, but we still maintain tremendous relationships with the factoring community and receivable financing to help them provide inventory revolvers to the same borrower without them having to put the money out themselves. And that's what we've been focused on for over 16 years in inventory revolving lines of credit.
All right, well, that sounds great, Lee. Thanks for the background. So what I'd like to do is jump right in. Today, what we're going to be discussing is, what's happening in the inventory finance market in that sector that you're working in. And I wanted to start off basically with the sector. One of the specific questions I have was, we know that the e-commerce sector is heavily reliant on inventory finance, and that's where you spend about 60% of your time, as you said, and retail. But I'm curious what you're seeing out there. What other industries are you seeing significant inventory financing needs today? And has that changed at all from maybe, let's say 2 or 5 years ago?
Well, again, good question. We certainly have seen in the last 2 years, very much due to the pandemic, that we've seen e-commerce be the leader in terms of the growth. They have, without a doubt, been overwhelmingly beneficial through this whole, COVID situation, because people are buying things online. Prior to COVID, I think the amount of e-commerce business was maybe less than 15%. Now it's increased by 25% last 2 years. So as a very big player in our world is the e-commerce brick and mortar type companies as well, or on-channel companies who have nothing but inventory to borrow on. And therefore, we are a great fit for an e-commerce or brick and mortar retailer who has nothing but inventory to pledge as collateral. That has the only other option for them is either equity or merchant cash advance type deal, which is really not the same type of lending as a revolver, which doesn't necessarily amortize. It just stays in formula and revolves around the inventory they hold for sale. But in addition to the growth we're experiencing, the growth in the industry of inventory within the e-commerce and brick and mortar retailers, is also the overwhelmingly need, given the supply chain issues, for other manufacturers and distributors to build up their inventory balances like never before. So if they have the opportunity to buy inventory in advance of their needs more than they had in the past, they are doing so, in which case their inventory sizes become bigger. And therefore, they need to borrow against it so they can keep in tune with the suppliers and the payables that they need to match with their people. That's what we found a big opening for us, is to provide the inventory revolvers, which are more than they used to be, for distributors and manufacturers who now need it more than ever.
That's interesting, Lee, because it kind of plays into one of my other questions I was thinking about was, and I call it, for lack of a better term, stockpiling of inventory. Supply chain issues have caused this problem. And as you said, some manufacturers, retailers, whoever it might be, are starting to hold more hold more inventory to ensure they have enough, and to have enough that's sufficient for them to meet their needs. But I'm curious, how does this impact the inventory lending that you're doing when you have this much more inventory on hand?
It's a very big challenge. The appraisers we work with are always apt to put in what they call slow moving inventory. So when you have an overabundance of inventory and therefore a time frame that would go beyond the normal liquidation period, normal selling period, then they look at that inventory as slow moving. So the bigger the buildup of inventory that they may have, while it may all be relevant to what they're selling and what they're doing, now all of a sudden they've got more inventory than they would expect to sell in the same selling period. So the appraisers look at that as slower moving inventory and therefore don't give us the same loan to value against it, even though the borrower, in this case, needs that inventory in order to make the sales they want to make because it's so stagnated. I mean, the biggest complaint we've had amongst our current borrowing relationships are the not having inventory to sell, and therefore they miss sales opportunities they could have had if they had the inventory. But as I said, conflicting with that is the appraisers, who we follow the lead on, who will tell us that that inventory, even though there's an excess amount of it, is now slow moving because they can't possibly sell through that inventory in the same period of time as usual.
So what happens from there then, Lee?
Well, we go ahead and we look to the appraised value. We try and be aggressive on it. You know, we try and build back in things. For example, we did a recent closing maybe about 6 months ago for a airplane sold pillow that goes around your neck. And this was where primarily they were coming out of the airports. We're now starting to open. They had stagnant sales before that. Airports were closed. Certainly the stores were closed. But we built our model based upon 2 years look back and decided that we had enough history and enough good feeling that the airports will go back and open up again, that people will start traveling again in greater, amounts than they had before. And sure enough, that resulted in the positive results that we're having right now. Now they're back in the airports again. The airports are back open again. Most of the retail stores are back open again. I just took a trip to Puerto Rico and back. It certainly seems to be almost like business as usual, except for a lot of people wearing masks. Other than that, it seems to be coming back. But for us, we try and look at what the appraisers provide, look at the status, and try and provide availability where maybe others would not, because we approach things much more business fashion. So it is a challenge to advance fully against all the inventory they're securing, but certainly we're getting a greater advance to them because of the amount of inventory they're stockpiling. And they need to. There's no other choice around it. If they don't have it, they can't sell it. And if we don't support it, then they can't pay the payables. So it's a challenge for us, but we are meeting the challenge and providing availability for them. I think the bigger challenge is in terms of in-transit inventory and deeming that to be something that we're going to lend on. We always had our challenges lending on inventory in transit because we needed freight forward agreements so nobody held our inventory hostage, et cetera. Making sure that the inventory that is on the water is the same inventory that's in their warehouses or Amazon fulfillment center, because we haven't had a chance to look at it at this point in time or inspect it, or the client to inspect it. Now, of course, is an added challenge too. If I'm going to lend something on in-transit inventory, I want to make sure that that ship is close to being, onboarded into the United States. Now, with all the delays still existing, and it's getting better, somebody has a product coming in, and it's delayed at the ports and delayed for greater than so many months, then I may have bet an over-aggressive loan against the inventory in transit. If it doesn't come in on time to meet their selling season or some seasonality issues, then all of a sudden I've lent on inventory in transit, which is still waiting to get to the United States and delayed by whatever, supply chain issues we're battling.
So this is a constant, we'll call it a battle, as you just said, a constant battle of balancing and rebalancing and recalculating to some degree, correct?
Absolutely. It's an absolute, and one of the reasons that banks don't like inventory or receivables for that matter as much is because it's a revolver. It requires constant monitoring. We do weekly borrowing basis. So every week there's a true up to understand how much inventory came in, what went out, what remains, broken down by the categories assigned by the appraisal when they did the appraisal initially. But, to create over advances, to create opportunities for the borrower to be able to get that inventory that they need requires a much more fluid response from us. And we look back at everything on a regular real-time basis to support their needs.
So I'm curious, you've got in-transit inventory. Have you had to actually adjust the value of some of the in-transit inventory as you've had money out the doors to some of these borrowers when you didn't anticipate it?
Not yet, but we are on top of these situations, tracking the inventory, knowing where it's at. We're in touch with the freight forwarders on the in-transit lending relationships. But no, we have not had to adjust it as yet. I would not want to be in the purchase order financing area right now, counting on a fulfillment of an order when my product's delayed on in transit. But from inventory standpoint, we are already lending a slightly lesser degree of against that inventory in transit than we had before because it's not here yet. So there may be additional costs in clearing it through customs and getting it on board to the United States. But beyond that, not yet, but we're watchful of that.
Okay, that makes sense. Just curious about this. Now we're talking about inventory, the different parts of inventory. I'm curious, are you lending against finished goods only, or are you lending against also raw materials and work in process? And let me finish that question actually. And if you are doing raw materials, for example, have you seen a change in the values of raw materials related to the supply chain? We
fund on finished goods, of course. But we also are aggressively funding when you're a manufacturer or value added. We lend on raw materials. We lend on work in process. We lend on finished goods. We lend on inventory areas where a third party appraiser gives rise to recovery value from it. So for example, at some points where they're manufacturing product and it's backed by potentially orders that they're putting it into finished goods, we will do what's called a build out appraisal, where we engage one of the appraisal services to tell us that if the music stopped tomorrow, which is always our worst case scenario we have to watch for, and everything's built around that worst case scenario, we look at the inventory and we say, okay, how do we take this inventory raw materials and convert it to finished goods? And if it be done in 2 weeks to 3 weeks, then we will do what's called a build out appraisal, where they employ what timing and what labor is needed to convert raw materials or work in process to a finished goods if it's already in work in process. Raw materials as a standalone item has tremendous value depending upon the category, because all of a sudden, I've got 3 deals right now in the oil and gas industry where I'm not lending anything against the finished goods because the finished goods get built into product and gets moved out the door right away. So there is really no finished goods. It's pipe, it's parts, it's couplings, but there is a value in that product to other manufacturers to be sold into the marketplace, and there are market conditions for it. So whether it's frozen foods or it's pipe, raw materials is a very big part of our lending relationships. So that to us is a very standard way of financing a transaction. And we've gotten appraisals recently that have just identified and just focused on the raw materials, which is the only collateral we're lending on. The raw finished goods go out the door immediately after it's been built. But the numbers are relevant. The recoveries are real, and they open up more opportunities than just the finished goods, which may have current customer base. And all of a sudden I'm looking at raw materials, which I have competitors and other people I have avenues to sell it to. So if you're lending on the raw materials as well, are you finding that there is a need to monitor the value of these raw materials from a worst case scenario standpoint, as you said? Are you looking very closely at this on a regular basis, more than you used to, in other words? We are, but everything we do is based upon a net orderly liquidation value, which anticipates a 90-day sell-through net of expenses that they may incur in moving that inventory out the door. Rent expenses, labor expenses, things that might be incurred to liquidate, whether it's a raw material or a finished goods or work in process. So we are staying on top of it, but for the most part, we get an appraisal done at the beginning of the transaction to give us a roadmap of what to lend on. And some of our borrowing bases that submitted weekly have maybe 20 different categories of inventory, from raw materials, finished goods, work in process, and each one of them may have subcategories beneath them. Each category has a different loan to value to account for the liquidation values of it. If there's a change in the industry, a change in the marketplace, a change in the borrower's sales, then we would want to updated appraisal to figure out the sell-through valuations of the raw material and how that may have changed in the marketplace. But often we don't do an appraisal more than once a year because we don't believe that things have changed to any degree where we need to, unless there's some substantial market condition that we have to pay attention to. But because we work as a revolving lender and not a term lender, we have the ability to adjust our relationship throughout. For us to make a loan on inventory is based upon the recovery values, et cetera, but we always work with a gatekeeper. So if it's a retail brick and mortar or e-commerce business, we're working in conjunction with one of the credit card processors to receive back the money we lent against the inventory when it gets sold. If not, one of the big plays for us is to make sure that we have a receivable finance company or a factor involved in commercial businesses, so we don't have to wait for the receivable to get collected. We get the money back out of the advance from the receivable lender or factor at the time of advance, which keeps us in formula against raw materials, et cetera. It also allows us to adjust accordingly, increase that holdback if we need to, because of market conditions or because we have to go down at a lower loan to value on the inventory that we had praised 9 months earlier.
Yeah, it makes sense. I understand. Okay. Well, my last question related to this is really about liquidations, and you touched on it a bit there, but, there's been all kinds of issues with supply chain. There's all kinds of issues in the values going on with inventory right now, as you mentioned. What are you seeing as far as how liquidations are being impacted today related to different types of inventory? Are you noticing anything that's really standing out to you?
Well, we're not, thankfully, we're not, involved heavily at this point in time in liquidations. Thankfully, we're building and continue to build based on new lines of credit that we've closed. But the challenges of liquidation are everywhere. If it's apparel or something in that marketplace, TJ Maxx used to be on the phone reaching out to the appraisers, liquidators to find out what they had in stock. Now they aren't reaching out as much. They've got plenty of inventory. They're still going through that. So it's definitely been a challenge. Unlike many lenders, because we do only inventory lending, we go through, like with a fine-tooth comb, the appraisals page by page to determine how they came up with their values, how they may change or be impacted upon market conditions, as opposed to just putting into a borrowing base what they told us. So that way we understand what the changes might be and how we might adapt to them. But an appraisal is a third party / liquidator's opinion on how we can get out of the inventory. They're the experts. We are good lenders, but we're not appraisers. We're not field examiners. So we employ people that know this business to tell us what the avenues of liquidation would be. And so far, in over 16 years, we've had great successes. We've been on track, but a lot of it's not a perfect world. Appraisers can make mistakes also. So we try and make sure that there's a real life scenario that we can follow up on to show that that's actually been true. And there's many times where we've challenged the appraiser's appraisal to say, well, I don't understand how that is going to work. In the real world, could you do some more phone calls to give you some more input? We can't just accept the way it is, because I know we only engage appraisal companies that also do liquidations. We want to make sure that the appraisers, the liquidators, are supporting what the appraisers are giving us as far as an exit strategy out of the deal. And from that standpoint, we have to stay on top of it. We reach out to them for current status, even if they have engaged them for an updated appraisal. And we try and work in also similar industries. It seems like when we get into one particular field, whether it's food, apparel, or oil and gas industries, it seems like we wind up with more of the same during a short period of time. So it gives us a better understanding of how we can liquidate, because we're looking at more than one client liquidation scenario. But they've been much more challenging than they ever have been before. So much more done remotely. Even the visits, which always used to be not a desktop, but an actual site visit, are becoming a little bit more acceptable now. But for a period of time, nobody would go to anybody's location to look at inventory, count the inventory, tell us the condition of the inventory, take a white glove out and see if there's dust on the inventory, the things that we want to understand. So the challenges are absolutely there, liquidations, but we're still holding firm. We're still holding well, and they've been pretty accurate so far.
Okay, great. Well, Lee, that wraps up my questions for today. I want to thank you for being here today and sharing your expertise on this. We'll probably be back to you in about a year or so, see what things are. But thanks for being here today and for telling us what you're seeing in the market.
My pleasure. Thank you very much for having me.